Hello and welcome back to The Note. Will 2014 be the year that the markets get to party like it's 1999? Well, that was the conclusion of a note that came out a few weeks ago from Absolute Strategy Research here in London, but it does require on there getting the answers to three key questions right. With me now to discuss this is the co-founder of Absolute Strategy, David Bowers. David, thanks for joining me once more. Now let's start. Your first question relates to corporate behaviour and particularly capital expenditures, whether companies are going to change their behaviour.
Yeah.
Take me through that.
Yes, I think the starting point is that over the last 5 years, companies have behaved in a very unusual way. They've essentially been running themselves for cash rather than for growth. They've been running themselves like bond proxies. They've been very hesitant to engage with the business cycle. I think one of the things that we're starting to see are growing signs that companies are starting to re-engage with the business cycle. They're starting to upgrade their capex plans. And as this chart shows very clearly, go back over the last 20 years, whenever you get a significant pickup in capex intentions, you tend to find that actually that's very supportive of stocks outperforming bonds. And I think this is a really key call, and I think the decline in the equity risk premium, the reduction in policy uncertainty are all starting to play quite a major role in companies now rethinking the way that they want to behave.
Okay, now there's obviously a very interesting call. You do mention how policy uncertainty, obviously a lot will depend on the attitude of central banks and the encouragement or otherwise they get from central banks to change their behaviour. What is your call on central bank behaviour?
Well, I think central bank behaviour is going to become increasingly clear. At the moment, I think it's in transition. For much of the last 20 years, it's been focused on targeting inflation. Now it's about targeting nominal growth and increased employment, and that is a fundamental shift.
If you're right,
if we're right.
I mean, this is the question. Are you right that there really is that kind of a regime change?
And I think it's happening. It's happening in a piecemeal way. It's happening in different regions at different rates. It's happening very rapidly in Japan, but taking a lot of time to happen in somewhere like the Eurozone. But it's a crucial shift where monetary policy, instead of being run for creditors, starts to be run for debtors. And by that we mean perhaps a tolerance for higher inflation and stronger nominal growth.
And companies tend to be debtors.
Absolutely.
Okay, now one particular role, though, the one country on which everything seems to depend, and we're not used to it depending on being particularly important, we're used to it being sort of an exception to the rule, is Japan. Now you've got a very interesting chart that we'll show you now on the way Japan has really been treated for a very long time as a pure currency play. How much depends on Abenomics in Japan? Could this pattern be about to change?
So I would argue that you can't forecast 2014 without having a view on Japan. And Japan has already had an impact on financial markets. It's one of the reasons why emerging market equities performed so badly in 2013. And I think you've got to come off the fence here and make a call as to whether Japan is going to continue to export deflation to the rest of the world. Or whether the radical shift in monetary policy is going to persuade Japanese corporates to start to spend rather than save, drive up wages and create something a bit more long-lived in terms of an economic recovery. It's an absolutely critical call, and my guess would be if you do succeed in creating a domestic narrative out of Abenomics, then you'll see the sensitivity of Japanese equities to the currency begin to diminish.
Now, what are the variables we need to look at in Japan, though? I mean, inflation, obviously they've been trying for a generation to revive inflation. At the moment, it's, I think I'm right in saying, just about the only developed market where inflation is rising, but it's still barely 1%. Is that the measure we need to be looking at, or how will we know?
So in a way, Japan encapsulates the first two themes that we talked about. We're looking for a change in corporate behaviour, therefore capex data remains very, very critical, because without capex you're not going to tighten the labour market and bring about a rise in wages. And it's also the market where you've got to really understand that the central bank is serious about that regime change and start to see a re-risking of Japanese savings. And I think those are the two things that will confirm a secular turn in Japan.
Okay, David, thank you very much indeed. I will now try bravely to paraphrase what we've just heard. If David and his friends at Absolute Strategy are right that first, there is a regime change towards more expansive capital expenditures by companies. Second, that there really is a regime change among central banks towards targeting employment rather than inflation. And thirdly, that Abenomics really does work more or less as intended, then we have a very good year on stock markets to look forward to. I'm sure he's right about that. Obviously, the question is whether he's right about the answers to those 3 questions.